Picture this. 1,043 banks collapsed, gone, vanished, taking with them the life savings of millions of Americans. The federal government wrote a check for $160 billion. That's $400 billion in today's money, just to clean up the mess. 5 United States senators found themselves at the center of a corruption scandal so brazen it changed how we think about political influence forever. Construction cranes stopped moving across entire states. Families lost their homes not because they couldn't pay, but because their banks simply disappeared overnight. This wasn't 2008. This was the savings and loan crisis, the financial disaster that reshaped American banking, destroyed political careers, and cost every single taxpayer in America roughly $2,000. Yet somehow this massive economic catastrophe has been almost completely forgotten. Today, we're going to uncover how a simple change in interest rate rules snowballed into the biggest bank failure in American history before 2008, why your parents or grandparents might have lost everything while Wall Street got rich, and most importantly, why the lessons from this crisis are screaming warnings about our economy today that nobody seems to hear. If you want to understand the economic disasters that shaped the world we live in today, the ones that happened while most people were looking the other way, hit that subscribe button and ring the notification bell. This is The Sleeping Economist, where we uncover the financial stories you slept through, and trust me, this one's going to blow your mind. Chapter 1: How Your Grandmother's Bank Became a Casino. To understand how over 1,000 banks failed, we need to go back to your grandmother's era, the 1930s. After the Great Depression wiped out millions of savings accounts, the government created something called Savings and Loan Associations, or S&Ls. Think of them as the boring, responsible cousin of regular banks. They had one job: take in deposits from regular folks, pay them a modest interest rate, and use that money to give out home mortgages to other regular folks. That's it. Simple, boring, safe. For 50 years, this system worked perfectly. S&Ls were so regulated they could barely sneeze without permission. The government told them exactly how much interest they could pay depositors, usually around 5.5%. They told them exactly what they could invest in, basically just home mortgages. They even told them they could only operate in their local area. It was like running a lemonade stand where the government controlled the recipe, the price, and where you could set up shop. But here's where our story takes its first dark turn. In the late 1970s, America faced something called stagflation. Prices were shooting up while the economy was tanking. Inflation hit 13% in 1979. Think about that. Every dollar you had was losing 13 cents of value every single year. Paul Volcker, the Federal Reserve Chairman, decided to fight inflation by jacking up interest rates to astronomical levels. By 1981, some interest rates hit 20%. Now imagine you're running an S&L. You've got millions of dollars in mortgages you gave out at 6% interest. That's your income. But suddenly, regular banks are offering 15% interest on deposits. Your customers are literally running out the door, pulling their money to chase those higher rates. You're bleeding cash, but you can't raise the rates you pay because of those government rules. You're trapped, watching your bank die in slow motion. By 1980, the entire S&L industry was technically insolvent. They owed $12 billion more than they actually had. The boring, safe cousin was suddenly on life support, and that's when politicians decided to try something that would echo through history. Instead of letting these institutions fail or fixing the fundamental problem, they decided to let them gamble their way back to health. Chapter 2: When Congress Gave Banks a Loaded Gun. In 1980 and 1982, Congress passed 2 laws that would transform S&Ls from boring mortgage lenders into financial wildcards: the Depository Institutions Deregulation and Monetary Control Act, followed by the Garn-Saint-Germain Act. These names sound boring, but what they did was revolutionary and ultimately catastrophic. First, they removed the interest rate caps. S&Ls could now pay whatever interest rate they wanted to attract deposits. Second, and this is the real kicker, they expanded what S&Ls could invest in. Remember, these institutions used to only make home loans. Now suddenly they could invest in commercial real estate, business loans, junk bonds, and even direct investments in real estate development. It was like telling someone who'd only ever driven a bicycle that they could now fly a fighter jet. But here's the part that should have set off every alarm bell in Washington. Deposits at S&Ls were still insured by the government up to $100,000 per account. Congress had actually raised this from $40,000, making it even more attractive to park money there, so S&Ls could now make incredibly risky investments, but if they failed, taxpayers would cover the losses. It was heads I win, tails you lose, the most dangerous game in finance. The results were immediate and dramatic. Money flooded into S&Ls, especially in states like California and Texas that had virtually eliminated state-level regulations. One S&L in California grew from $11 million in assets to $2.5 billion in just 4 years. How? By offering interest rates that were completely insane, sometimes 2 or 3% above what regular banks offered. Enter the cowboys, a new breed of S&L owners who saw opportunity in this chaos. People like Charles Keating, who bought Lincoln Savings and Loan in 1984, or Don Dixon, who turned Vernon Savings and Loan in Texas into his personal piggy bank. These weren't traditional bankers. They were real estate developers, entrepreneurs, and in some cases, straight-up con artists who realized they'd been handed the keys to the kingdom. The money started flowing into increasingly crazy investments: shopping malls in the desert, condo developments with no buyers, junk bonds from companies that had no business borrowing money. One S&L in Texas loaned $100 million to a single borrower for a real estate project that existed only on paper. Another flew its executives to Europe on the company jet to look at castles they might buy. This wasn't banking anymore. It was fantasy finance, fueled by government-insured deposits. Chapter 3. The day the music stopped. By 1985, the warning signs were everywhere. In Ohio, Home State Savings Bank collapsed after losing $145 million in a securities fraud. The collapse triggered the first bank run since the Great Depression. People lined up for blocks, desperate to get their money out. The governor had to declare a bank holiday, literally closing S&Ls for days to stop the panic. But Ohio was just the appetizer. In Texas, the real estate market began to crack. Oil prices had collapsed from $37 a barrel to under $10, taking the Texas economy with it. Those shopping malls in the desert? Empty. Those condo developments? Ghost towns? Those business loans to oil companies? Worthless. By 1987, 1/3 of all S&Ls in Texas were insolvent. Then came the moment that would define the crisis: the failure of Lincoln Savings and Loan in 1989. Charles Keating had turned Lincoln into a junk bond investment machine, moving billions of dollars of federally insured deposits into high-risk investments. But Keating had an insurance policy of his own. 5 U.S. senators who had received $1.3 million in campaign contributions from him. When federal regulators tried to shut down Lincoln in 1987, these 5 senators, who would become known as the Keating Five, intervened. They met with regulators and essentially told them to back off. The delay cost taxpayers an additional $2 billion as Lincoln continued to hemorrhage money for 2 more years. When it finally collapsed, 23,000 customers lost their life savings. Many were retirees who had been convinced by Lincoln employees to move their federally insured deposits into uninsured bonds, a practice that was straight-up fraud. The public finally woke up to what was happening. The image of elderly retirees crying outside Lincoln Savings branches, holding worthless bonds they thought were insured deposits, became the face of the crisis. Congressional hearings revealed the depth of corruption. Charles Keating, when asked if his political contributions influenced the senators, simply said, "I want to say in the most forceful way I can, I certainly hope so." By 1989, newly elected President George H.W. Bush had no choice but to act. The S&L industry wasn't just failing, it was taking the entire financial system down with it. In August 1989, he signed the Financial Institutions Reform, Recovery, and Enforcement Act, creating the Resolution Trust Corporation to clean up the mess. The RTC would become the largest liquidation entity in world history, tasked with selling off the assets of hundreds of failed S&Ls. Chapter 4. Counting the bodies and the billions. The numbers were staggering. Between 1986 and 1995, 1,043 S&Ls with assets of over $500 billion failed. To put that in perspective, that's more than the GDP of most countries. The Resolution Trust Corporation had to sell off everything from office buildings to artwork, from shopping centers to actual castles that one S&L had somehow acquired. The human cost was even worse. Thousands of S&L employees lost their jobs overnight. Construction workers across Texas, Arizona, and California found themselves unemployed as real estate development ground to a halt. Small businesses that had relied on S&L loans suddenly couldn't get credit anywhere. Entire communities built around real estate development became ghost towns. The legal aftermath was unprecedented. Over 1,000 S&L executives were prosecuted for fraud. Charles Keating was sentenced to 10 years in prison, though he served less than 5. Don Dixon of Vernon Savings got 5 years for using depositor money to pay for prostitutes and his beach house. The Justice Department created special task forces just to handle S&L crimes, prosecuting everyone from CEOs to accountants who had signed off on fraudulent statements. The political fallout was just as dramatic. The Keating 5 scandal destroyed careers. Senator Alan Cranston of California was formally reprimanded by the Senate Ethics Committee. John McCain, who was also one of the 5, saw his presidential ambitions temporarily derailed, though he would eventually recover. The scandal fundamentally changed how Americans viewed the relationship between money and politics. But here's the truly shocking part. The final cost to taxpayers was $160 billion. That's roughly $2,000 for every taxpayer in America at the time. In today's money, that's over $400 billion. And unlike the 2008 bank bailouts, where much of the money was eventually paid back, this money was gone forever. It had been invested in empty shopping malls, worthless junk bonds, and straight-up stolen through fraud. The government's response reshaped American banking forever. The Federal Deposit Insurance Corporation Improvement Act of 1991 gave regulators new powers to shut down failing banks before they became black holes for taxpayer money. Capital requirements were raised, meaning banks had to keep more of their own money on hand. The days of using federally insured deposits like casino chips were supposedly over. Chapter 5. The Lessons We Refused to Learn. The S&L crisis should have been a wake-up call about the dangers of deregulation without accountability. Instead, it became a forgotten chapter in American economic history, overshadowed by the tech boom of the 1990s and eventually the 2008 financial crisis. But the patterns it established would repeat themselves with frightening accuracy. The Resolution Trust Corporation spent 6 years cleaning up the mess, eventually recovering about 85 cents on every dollar of assets from failed S&Ls. They pioneered new ways of packaging and selling distressed assets that Wall Street would later adopt and expand. In a dark irony, the techniques developed to clean up the S&L crisis would later contribute to the mortgage-backed securities crisis of 2008. The impact on American communities lasted far longer than the crisis itself. In Texas, commercial real estate values didn't recover to their 1985 peaks until the late 1990s. Entire neighborhoods in cities like Houston and Dallas remained half-empty for years. The psychological impact was even deeper. A generation of Americans learned that even boring, government-insured banks could disappear overnight. The regulatory framework created after the crisis worked, for a while. Throughout the 1990s, bank failures dropped to historic lows. But memories are short in Washington. By 1999, Congress passed the Gramm-Leach-Bliley Act, dismantling the Depression-era walls between commercial banking, investment banking, and insurance. The argument was that American banks needed to be bigger and less regulated to compete globally. Sound familiar? The S&L crisis also transformed American politics. The Keating 5 scandal led to new ethics rules in Congress, but it also taught a different lesson to those paying attention: the value of political connections in the financial industry. The amount of money flowing from Wall Street to Washington increased exponentially after the crisis. Campaign contributions from the financial sector grew from $61 million in 1990 to over $2 billion by 2016. Perhaps most importantly, the crisis established a precedent that would haunt American capitalism: the idea that if a financial institution got big enough and interconnected enough, the government would have no choice but to bail it out. The term "too big to fail" wasn't common during the S&L crisis, but the principle was established. When long-term capital management nearly collapsed in 1998, when Bear Stearns failed in 2008, when AIG needed a bailout, the playbook had already been written during the S&L crisis. Chapter 6. Why this story matters to you today. So, why should you care about a banking crisis that happened before many of you were born? Because the S&L crisis reveals timeless truths about how financial disasters really happen, and these patterns are visible in our economy right now if you know where to look. First, watch for the deadly combination of deregulation and government guarantees. When businesses can take massive risks with other people's money while knowing taxpayers will cover the losses, disaster is inevitable. Today, we see this in everything from student loans to mortgage markets. The players change, but the game remains the same. Second, pay attention when boring businesses suddenly become exciting. S&Ls were supposed to be dull institutions making modest profits from home loans. When they started promising sky-high returns and making exotic investments, that should have been a massive red flag. Today, when you see traditional businesses suddenly claiming they're tech companies or cryptocurrency plays, remember the S&Ls. Third, political connections matter more than most people realize. The Keating Five showed us that campaign contributions can buy more than just access. They can buy time, and in finance, time is money. When you see financial executives making massive political donations or regulators taking jobs at the companies they used to oversee, remember Charles Keating's words, "I certainly hope so." Fourth, generational amnesia is real and dangerous. The S&L crisis cost more than any financial disaster in American history up to that point, yet it's been largely forgotten. The executives who created the 2008 crisis were old enough to remember the S&L crisis, but they repeated the same mistakes anyway. The lessons we refuse to learn from history become the disasters we're doomed to repeat. Finally, and most importantly, understand that in any financial crisis, regular people pay the price. The S&L executives who committed fraud went to minimum security prisons for a few years. The politicians who enabled them retired with full pensions. But the retirees who lost their life savings, the construction workers who lost their jobs, the taxpayers who funded the bailout, they carried the real cost for decades. The warning signs from the S&L crisis are flashing again today. We have financial institutions making increasingly risky bets. We have regulators who seem more interested in protecting banks than consumers. We have politicians who take millions from the financial industry while claiming to represent regular Americans. We have a generation that doesn't remember the last crisis and thinks this time is different. But here's what you can do. Stay skeptical of investments that seem too good to be true. They usually are. Diversify your savings beyond just one institution or investment type. Pay attention to who your politicians take money from and how they vote on financial regulation. And most importantly, learn from history, because those who forget the past aren't just doomed to repeat it, they're doomed to pay for it. The S&L crisis wasn't just a financial disaster, it was a preview of coming attractions. The mechanisms that allowed it to happen are still in place, just with different names and fancier technology. The next crisis won't look exactly like the S&L disaster or the 2008 meltdown, but it will rhyme with them. And when it happens, those who understood the lessons of the S&L crisis will be the ones who see it coming. If stories like this fascinate you, where we uncover the economic events that shaped our world while most people weren't paying attention, hit subscribe and the bell icon, because we're just getting started with these financial mysteries.